In 1971, foreign central banks started demanding gold instead of dollars. Within months, President Nixon was forced to close the gold window, ending the dollar's link to gold forever. The currency lost 98% of its purchasing power over the next 5 decades. Today, central banks are doing something they haven't done since that pivotal year. They're buying gold at the fastest pace in modern history. And for the first time since 1996, gold now makes up a larger share of global central bank reserves than U.S. Treasury bonds. They're not doing this by accident. The question isn't whether central banks know something we don't. The question is what exactly they're preparing for. Let's start with the numbers, because the numbers are staggering. Gold just recorded its best year since 1979. The metal surged 66% in 2025, climbing from $2,600 to over $4,500 per ounce. This week, it broke $4,600, setting its 50th record high of the year. But here's what matters more than price. Central banks collectively purchased over 1,000 tons of gold in 2025. That's the third consecutive year of purchases, exceeding 000 tons. Before 2022, the annual average was around 400 tons. Something fundamentally changed. Poland's central bank alone bought 95 tons. Kazakhstan added 49 tons. India purchased 43 tons in just 3 months. China, despite officially reporting modest additions, is widely believed to be accumulating far more through unreported channels. J.P. Morgan now forecasts gold reaching $5,000 by the end of 2026. Bank of America sees similar levels. Morgan Stanley revised their target to $4,400, calling the rally structural rather than cyclical. These aren't fringe predictions from gold bugs. These are the largest financial institutions in the world telling their clients to expect significantly higher prices. The obvious question is why? To understand what's happening, we need to understand what central banks actually do with their reserves. For decades, the formula was simple. Central banks held dollars. Specifically, they held U.S. Treasury bonds, IUS from the American government. This made sense for several reasons. Treasuries were considered the safest asset on earth. They paid interest. They were liquid. And because global trade was conducted in dollars, holding dollars meant holding the currency you needed to participate in the world economy. At its peak in 2014, foreign central banks held over 40% of all U.S. Treasury bonds. America could run massive deficits because foreign governments would reliably show up to buy the debt. This arrangement, sometimes called the exorbitant privilege, allowed the United States to consume more than it produced for generations. That arrangement is unwinding. Foreign official holdings of treasuries have dropped below 15% of the total market. In October 2025 alone, BRICS nations sold $29 billion worth of U.S. debt. Over the past 12 months, China offloaded $71 billion. India sold $51 billion. Brazil dumped $61 billion. They're not just selling treasuries. They're actively replacing them with gold. This represents the most significant shift in global reserve management since the end of Bretton Woods. Central banks are making a deliberate choice to hold an asset that pays no interest, generates no yield, and simply sits in a vault. That choice tells us everything about how they view the alternative. History offers an uncomfortable parallel. In the 1960s, foreign central banks began losing confidence in the dollar's gold backing. The United States was printing money to fund the Vietnam War and domestic spending programs. Foreign governments, particularly France under Charles de Gaulle, started exchanging their dollars for physical gold from Fort Knox. By 1971, the drain became unsustainable. America's gold reserves fell from over 20,000 tons after World War II to barely 8,000 tons. On August 15th, Nixon announced that the United States would no longer convert dollars to gold at any price. The Bretton Woods system, which had governed international finance since 1944, collapsed overnight. What followed was a decade of monetary chaos. The dollar lost over 30% of its value in 3 years. Inflation reached double digits. Gold prices increased tenfold by 1980. The entire financial architecture of the post-war world had to be rebuilt. The current situation shares disturbing similarities. Central banks are once again exchanging paper claims on the U.S. government for physical gold. The accumulation is not speculative, it's strategic. Countries are moving metal from Western vaults to their own territories. China reportedly stores gold in Shanghai and Beijing. India repatriated gold from London. Even Poland, a NATO ally, brought its gold home from the Bank of England. When central banks start physically moving gold across borders, they're not making a trade. They're making a statement about trust. Central bankers don't hold press conferences explaining their gold purchases, but their actions reveal their concerns. The first concern is sanctions. In 2022, Western nations froze $300 billion in Russian central bank reserves held in dollars and euros. Regardless of one's opinion on the conflict, this action demonstrated something every central banker noticed. Reserves held in another country's banking system can be seized. Gold held in your own vault cannot. This wasn't lost on China, which holds over $3 trillion in foreign exchange reserves. It wasn't lost on India, Brazil, or any nation that might one day find itself on the wrong side of Western policy. The weaponization of the dollar created a powerful incentive to hold an asset that cannot be frozen, sanctioned, or confiscated with a keystroke. The second reason, number two, the $38 trillion fiscal dominance trap. Concern is debt. U.S. national debt now exceeds $38 trillion. Interest payments alone cost $1. $2 trillion in 2025, more than the entire defense budget. The Congressional Budget Office projects deficits of $2 trillion annually for foreseeable future. Janet Yellen herself recently warned about fiscal dominance, a scenario where debt becomes so large that the Federal Reserve loses its ability to control inflation without triggering a government funding crisis. Central banks can see these numbers. They can see that America is adding debt faster than it can service existing debt. They can see that there is no political will in Washington to address the problem. And they can see that throughout history, governments facing unsustainable debt have reliably chosen inflation as the least painful exit. Painful for creditors. That is, gold is the only reserve asset that is no one else's liability. It cannot be printed, diluted, or defaulted upon. In an era of exploding government debt, that property becomes increasingly valuable. The third concern is the monetary system itself. For 80 years, the global financial system has been built on the dollar, but BRICS nations are actively constructing alternatives. They're settling trade and local currencies. They're building payment systems outside SWIFT. They're discussing gold-backed settlement mechanisms that would bypass the dollar entirely. These efforts may take decades to mature, but central banks think in decades. When they accumulate gold today, they're positioning for a world that may look very different in 2035 or 2045. They're hedging against a future where the dollar is not the only option. There's a profound irony in what's happening. The United States holds more gold than any other nation. Over 800 tons stored primarily at Fort Knox in the New York Federal Reserve. This gold has sat essentially untouched since Nixon closed the gold window. It's valued on the Federal Reserve's books at the absurd price of $42 per ounce, a relic of the 1970s that nobody has bothered to update. At market prices, America's gold reserves are worth over $750 billion. Yet, this gold plays no active role in monetary policy. The Fed doesn't buy it or sell it. The Treasury doesn't reference it. For all practical purposes, it might as well not exist. Meanwhile, China has been accumulating aggressively for over 15 years. Official figures show roughly 2,300 tons, but analysts estimate true holdings could be double that amount. The People's Bank of China purchases domestic mine production directly, never reporting these additions to international databases. Russia added over 1,500 tons since 2008, becoming the fifth largest holder globally. Even smaller nations are joining the accumulation. Singapore, Poland, Czech Republic, Uzbekistan. The list of buyers spans continents and political alignments. The collective message is clear. Nations around the world are preparing for a monetary future in which gold regains importance it hasn't held since the 1960s. The only major central bank not participating in this accumulation is the Federal Reserve. Either America knows something every other central bank doesn't, or every other central bank knows something America refuses to acknowledge. The physical gold market is showing signs of strain. Premiums in Shanghai consistently trade above linen prices, sometimes by significant margins. This indicates strong Asian demand pulling metal eastward. Gold is leaving Western vaults, the Bank of England, the COMEX warehouses in New York, the Swiss refineries, and moving to Asia. ETF inflows accelerated dramatically in 2025. Investors added over 250 tons to gold-backed funds, the strongest year since the pandemic. Retail demand for bars and coins exceeded 1/200 tons. Even Costco now sells gold bars, and they reportedly sell out within hours. This demand is colliding with limited supply growth. Global mine production has been essentially flat for years at around 3,500 tons annually. New discoveries are rare. Permitting timelines stretch decades. Environmental regulations make new projects increasingly difficult. The implication is straightforward. If central banks continue purchasing at current rates, if investment demand remains strong, if mine supply stays flat, prices must rise to balance the market. The path of least resistance is higher. Yet, Western financial institutions have been remarkably slow to recognize this shift. Most pension funds hold minimal gold exposure. Most portfolio models still recommend allocations of just 25%. The traditional 60-40 stock bond portfolio assumes that Treasury bonds provide safety in a crisis. Central banks are quietly suggesting that assumption may no longer hold. What central banks do matters more than what they say. They manage trillions in reserves. They employ armies of economists and analysts. They have access to data and intelligence that ordinary investors cannot obtain. And when they collectively make the same decision, it deserves attention. For 3 consecutive years, central banks have purchased over 1,000 tons of gold annually. They have done this despite gold paying no yield. They have done this while interest rates rose. They have done this even as prices reached all-time highs. Each of these factors would traditionally discourage gold purchases. Yet, the buying continued. The World Gold Council's annual survey found the strongest intention to increase gold reserves since the survey began. Central bankers were asked about their plans for the next year, and an unprecedented number indicated they would buy more gold, not hold, not reduce by. This is not about short-term trading. Central banks don't try to time markets. They make strategic decisions based on multi-debt outlooks. When they accumulate an asset for 3 straight years, they're expressing a view about the next 30 years. That view appears to be skepticism about paper currencies in general and the dollar in particular. If central banks are right, the implications extend far beyond gold prices. A world where gold regains monetary importance is a world where the dollar's dominance fades. American consumers would face higher import prices. The U.S. government would pay higher interest rates. The exorbitant privilege that allowed decades of deficits would erode. This transition wouldn't happen overnight. Reserve currency status shifts slowly over decades rather than years. The British pound remained important long after the British Empire faded. The dollar would remain significant even in a more multipolar monetary world. But the direction matters. Central banks are preparing for a world where they need alternatives to the dollar. Gold is the oldest alternative, the one that predates nation-states and paper money by millennia. When trust in institutions declines, trust in gold tends to rise. The 20th century was an anomaly in monetary history. For 5,000 years before that, gold was money. The experiment with pure fiat currencies, backed by nothing but government promises, is barely 50 years old. In historical terms, we're still testing whether it works. Central banks appear to be hedging their bets. Gold teaches a lesson that modern finance prefers to ignore. It cannot be created by committee decision. It cannot be printed during a crisis. It cannot be devalued to make debts more manageable. Its supply grows by roughly 5% per year, the approximate rate of new mining production. No government can change this. These properties made gold unsuitable for modern central banking. which requires flexibility to respond to crisis. Economists dismiss gold as a barbarous relic, a primitive form of money unsuited to sophisticated economies. Yet here we are. The most sophisticated financial institutions in the world with access to every modern instrument and derivative are choosing to hold yellow metal in underground vaults. They're choosing an asset that pays nothing over assets that pay interest. They're choosing physical possession over financial claims. This choice reflects a simple calculation. Modern financial assets, bonds, currencies, derivatives all depend on counterparty trust. They're promises that someone else will honor their obligations. Gold depends on no one. In an era of declining institutional trust that independence has value, recent events underscore why central banks might prioritize independence. The Federal Reserve Chair is under criminal investigation, whether or not the charges have merit. The spectacle damages institutional credibility. Markets watched Jerome Powell issue an extraordinary statement defending Fed independence while facing potential indictment. Gold prices spiked the same day. The investigation reflects broader pressure on central bank independence. Political leaders increasingly view monetary policy as a tool for achieving short-term objectives rather than long-term stability. When institutions become politicized, the assets they control become less trustworthy. This is not unique to America. The European Central Bank faces pressure from member states with conflicting interests. The Bank of Japan has monetized government debt to an extreme degree. Central banks globally have expanded their balance sheets, blurring the line between monetary and fiscal policy. Against this backdrop, gold's appeal is straightforward. It exists outside the political system. No election can change its properties. No policy